Hi, I'm Ying and Cheng, Portfolio Management Director at Coolabah Capital, and I'm joined by my colleague Christopher Joye, CIO and Senior Portfolio Manager at Coolabah Capital. And today we're going to discuss the existential investor choice. Does one add value or do we add risk? I'm going to frame today's discussion with the following problem. With the RBA's cash rate at 0.13% and the average term deposit rate at 0.65%, where do investors find safe and liquid income that is going to beat a 2% inflation rate by a decent margin? On the slide here, we have summarized key fixed income investments. And in fixed income, the best distillation of risk is yield. On the right-hand side, we've taken these fixed income investments and we've summarized their key risks, including their credit rating, their liquidity risk, their interest rate risk, their credit risk, and the risk of mark-to-market loss. Chris, can you elaborate?
Yeah, sure, Ying. So I think what you can see here is that different investments offer different returns, and the yields are summarized on the chart here, but they come with trade-offs. So you can actually get a higher return than a TD rate by investing in a 10-year Aussie government bond. But if we look across to its risks, it has no credit risk, it has great liquidity, but it has very high interest rate risk. And that means that if interest rates increase, the price of the bond will fall, and you can actually suffer large losses. Conversely, you can get a great return on AAA rated non-bank RMBS of, say, almost 3%. But the problem with this is that non-bank RMBS can have no to very poor liquidity. So it doesn't have interest rate risk, doesn't have much credit risk, but if you need to access your cash, you may not be able to. Final example is high yield bonds. So in high yield bonds, you can get very attractive income of 5.7%, but you have probably average to poor liquidity and very high credit risk. So very high risk of default. And you also can have quite significant interest rate risk. So that problem again, that if interest rates rise, the price of these bonds may decline. The extreme example of this is, of course, Virgin Senior Bonds, which listed on the ASX in November last year. They offered a very attractive 8% yield, but unfortunately Virgin went into default and these bonds ended up being absolutely worthless.
How do you decide when given the choice between a BB plus rated regional bank hybrid yielding 3.6% per annum or a AA rated non-bank below prime RMBS also yielding 3.6% per annum, or Woolworths shares with a 3.6% dividend yield? Or, to capture more yield, a B-rated global high yield bond yielding 5.7% per annum, or CBA shares with a 6.5% dividend yield?
Yeah, I think, Ying, is that the point here is there's no free lunch. Stuff can look very safe. It might have a high credit rating, like that AA rated non-bank yet subprime RMBS. So it can look safe, but it's paying a high yield for a reason. And that's because it's concealing other risks, specifically liquidity risk. Another example would be high yield bonds. They're paying 5.7% per annum. That seems attractive, but it's actually pretty similar to the yield you get on most stocks, particularly bank stocks. And what we actually find is that high yield bonds tend to have features that make them perform like equities in a risk and return sense.
So on this chart, we've highlighted various investments. And the key question is, do investors really understand the risks? For these various investments, we've captured their maximum monthly capital gain and also the maximum monthly capital loss. Chris, can you speak to what this slide is illustrating?
I think it highlights the point that, and most of these losses were March 2020. We saw global high yield bonds suffered a large 13.5% loss. Listed high yield bond funds were down 25%. That's pretty similar to what equity suffered. That is a 21.5% loss. And even highly rated non-bank RMBS fell 17%. Conversely, if you look at, for example, the hybrid market, it actually performed pretty well in March 2020. It only lost 6%. It actually outperformed tier 2 or subordinated bonds. We see, interestingly, that 10-year government bonds, whilst they might be AAA rated and government guaranteed, on a mark-to-market basis, they can also suffer quite large losses of around 2.5% in any given month. Interestingly, their maximum loss is actually larger than the loss you would have incurred in March 2020 on floating rate senior bank bonds. And that's because these fixed rate government bonds are embedding interest rate risk. And if inflation pressures build and long-term interest rates, heaven forbid, start to increase, you can actually have some non-trivial downside and capital losses.
So investors are faced with two choices: to add value or to add risk. Chris, can you explain what we mean by this?
Yeah, adding value really means doing the hard work to find cheap bonds that are mispriced. These are bonds that are going to give you price appreciation or capital gains, or what we call alpha, as their valuations normalize back to fair value. And you want to invest in very safe, liquid, and ideally highly rated securities that have minimal intrinsic credit or default risk. These are securities that are less likely to become illiquid or go into default in times of stress like we saw in March 2020. The alternative is you add risk. So you don't add value, you just chase a yield. And so you are going to be looking for assets that are paying high interest rates or yields to compensate you for that risk. And that risk, as we mentioned, can be credit default risk, illiquidity risk, or interest rate risk. And when you're adding risk, you just buy and hold, you'll capture that yield, and you really hope that nothing will go wrong.
So adding value allows high returns from low yield assets. And in this chart, you can see that there are multiple ways to add more return. What is fairly easy to deliver is by giving investors more risk. This can take the form of interest rate duration risk, i.e. investing in longer dated fixed rate bonds that compensate you for losses on interest rate risk, or taking on more credit risk, i.e. investing in high yield bonds or loans, or sub-investment grade securities that are rated BB, B, or CCC, and even unrated instruments. The other way to drive more return, and is quite easy to deliver, is also investing in illiquid loans, illiquid corporate bonds, and illiquid ABS and RMBS to compensate you for illiquidity risk. What is harder to deliver is capturing capital gains or alpha via finding mispriced bonds and trading. Adding value means you don't blindly diversify. Chris, can you explain what we mean by this?
Yeah, sure, Yingers. I think in fixed income, people often feel that it's a safe investment if the portfolio has hundreds or even thousands of bonds, but blindly diversifying actually carries large risks, and it gives, I think, an appearance of artificial security. And what we saw in March 2020 is that excessive diversification can introduce correlated default and correlated liquidity risk. And we saw this with bonds issued by airlines, retailers, real estate companies, and non-bank lenders issuing ABS and RMBS. All these bonds performed badly at the same time because their credit default risk and their liquidity risk increased at the same time. Nobody wanted to buy these bonds, and perhaps people had forgotten how they'd perform in a recession, given we hadn't had one in Australia since 1991. And I think that's an important point, that credit portfolios or fixed income investments hadn't been properly stress tested since 1991 by way of a domestic recession. We certainly saw when the tide receded that there was a tremendous amount of illiquidity. On the other hand, we didn't have that difficulty. We were very active and traded about $1 billion worth of bonds in the month of March because we only focused on liquid assets that were always tradable during those difficult times. And this problem with liquidity really manifests in other ways. In the chart on the right-hand side, we're actually comparing the value of a floating rate note ETF in Australia to its claimed net asset value. And the Bank for International Sentiments, Invesco, and the Bank of England have all concluded that in March, the net asset values were stale. They weren't updated, and they weren't reflecting the true losses in fixed income because assets weren't trading. So that illiquidity was concealing a huge amount of risk. But with the ETF price itself, we saw that plummet. And that's because ETF prices were reflecting the real valuations that investors were prepared to transact on. Those real valuations were very, very different to the claimed NAVs. And we saw a similar problem with high yield bond funds that had listed on the ASX, where they typically traded in March at a 25 to 50% discount to their NAV. So they fell up to 50% in value and price terms because the NAVs weren't tracking the true valuations of those assets, because those assets had very low or no liquidity and weren't transacting. That is the underlying assets in the portfolio itself. But people buying and selling units in the LITs were expressing their views as to what those assets were really worth.
And generating returns by finding capital gains or alpha requires a very large team. Chris, can you introduce our 24-person executive team?
Sure, Yingers. Yeah, we have 12 analysts and 5 portfolio managers spread across offices in London, Sydney, and Melbourne. We have a lot of quantitative and technical capabilities. 4 of our executives have PhDs in astrophysics, computer science, engineering, pure mathematics, and aerospace engineering. And we have a number of other engineers and mathematicians in the team who are building many different quantitative valuation models to price assets live in real time throughout both the Australian and offshore markets to try and figure out where fair value lies and to try and find mispriced assets that are cheap and that will give us capital gains so that we're not reliant on those yields, so that we don't have to chase risk, so that we can really pursue true credit alpha or true price appreciation that is independent of the risk factors that we've talked about: credit risk, liquidity risk, and interest rate risk.
And to illustrate this, adding value also requires very active trading. Chris, can you explain what we see on this slide?
Yeah, this is actually showing our monthly trading volumes. The pink bars are the buys and the aqua bars are the sells, and this is in terms of the number of trades each month. But in terms of the value of trades, we've traded about $17 billion of bonds in the last 10 or so months. And you can see that we're very active in both January, February, March, and April. So we had no problems with liquidity at all. And we've done over 14,000 buys and sells over this period. So we've had these very high activity levels, relentlessly searching for mispricings, looking for capital gains, and not relying on the bond yield as such.
And adding value also requires proven alpha generation. Chris, can you speak to this evidence?
Yeah, what we're seeing here on this chart is every bond sale that we've ever effected since 2012. That's the horizontal axis time. On the vertical axis, we have the return. These are the pre-fee non-annualized returns, and each of these black dots is a different bond sale. Across all the buys and sells, we've had a win ratio of 98%, so we make money 98% of the time, and that's across $14.5 billion of bond sales. We're looking at north of 15,500 individual sales, and the value-weighted credit rating is very high at A+, and that really, I guess, speaks to the security of the underlying assets and our ability to trade in and out of those assets. As we all know, we've built a long track record through several different products, which are highly rated in all of their peer universes.
Chris, can you explain this return attribution analysis that we've done for 2020?
Yeah, so this is really tracking the year to date across 4 of our key strategies, and it's looking at the sources of returns. And the key thing to take away here, noting the disclaimers that past performance is no guide to future returns, is simply that over the last 9 months, between 43% and 63% of the total return that we've generated has come from capital gain. And that's really important in a world where yields are falling and it's increasingly hard to find attractive income without taking on huge liquidity, credit, or interest rate risk. Buying and selling very actively day in, day out through that 24-person team, the 12 analysts and the 5 PMs and the 4 PhDs, and by revaluing assets aggressively and regularly, we're looking for those mispricings and looking for opportunities to generate alpha, not beta, looking for opportunities to drive return through skill, not through risk and luck. So on this slide, we're now going to quickly talk about a key idea that we've been focused on over the last 12 months or so, and that is the Aussie housing market. And Ying, I might just hand over to you to talk through this slide and a few other ideas that we've been advancing of late.
Our core view around Aussie housing is that we're expecting strong house price growth of between 10 to 20% over the next few years. In March 2020, we had the highly contrarian view that house prices would only fall modestly by 0 to 5%, which was definitely the most positive mainstream view out there. And as you can see, that there were multiple analysts that disagreed with us, and they were in fact looking for at least house price falls of between 10 to 30%. To date, over the 8 capital cities, house prices have only fallen by 2.8%. We have been vindicated on our views here. And it looks like as house prices are picking up again nationally, bears are also embracing our views. So we're seeing the investment banks adjust their forecasts in line with ours. There are several drivers of our very constructive outlook, and this includes the 150 basis points reduction in fixed mortgage rates since mid-2019, the positive income growth care of the huge fiscal stimulus that we've seen, also the net large increase in home buyer purchasing power, and the advent of positive gearing. What we've seen across the major cities is that gross rental yields on apartments are actually around 5%. And with fixed mortgage rates around 2.5%, we're seeing positive gearing for the first time. In addition, we're seeing very strong offshore demand from expats returning back to Australia and also Asian buyers, possibly motivated by geopolitical reasons. So Asian buyers from Hong Kong, Taiwan, and mainland China. The repeal of the responsible lending laws will be incredibly supportive as well, and that has been something that Coolabah has been calling for since 2018. And also the expectation of a positive surprise in net overseas migration as Australia seeks to attract the top global talent and also capital. What we also saw in the most recent Commonwealth budget were measures to support first-time buyers with an additional 10,000 new guarantees. Most importantly, Chris, the RBA's own internal research shows that a 1% drop in mortgage rates as at Jan 2019 would increase house prices by 28%. If we project that going forward, then we are in for a very strong rebound.
Yeah, Ying, I think one of the other interesting points here is that we're seeing in September, the month of September, strong capital gains across 6 of the 8 cities nationally. So in Perth, Canberra, Hobart, Brisbane, Adelaide, Darwin, and then also capital gains, house price growth in all non-metro regional markets. And it's also clear that the rate of capital loss in Sydney has really decelerated markedly. Clearly the one laggard is Melbourne. We were surprised by the second wave in Melbourne. We haven't had that problem in any other state or territory nationally, or obviously in New Zealand. But nonetheless, as Melbourne comes out of lockdown, we expect that market to stabilise.
Our expectation at Coolabah is that we believe the RBA will cut the cash rate from 0.25% to 0.1% next month, i.e. November, and also cut the cost of the term funding facility, otherwise known as the TFF, for banks from 0.25% to 0.1%. We also expect the RBA to lower its 3-year government bond yield target to the same rate, 0.1%. And we also expect them to purchase longer dated government bonds of between 5 years and 10 years in tenor. And we also expect the RBA and APRA to also force the banks to switch their $223 billion committed liquidity facility, which is their emergency borrowing facility, into government bonds and state government bonds over time.
Yeah, I think what's interesting about that, Ying, is we've actually just this week had confirmation from APRA that it is indeed going to wind down their CLF and encourage banks to shift a lot of that money into government bonds and semi-government bonds. And we've also seen Phil Lowe's speech this week signalling very strongly that these projections will indeed come to pass. So signalling that the RBA will cut its cash rate, the TFF rate, the 3-year government bond yield target, and will also importantly commence purchases of 5 and 10-year government bonds. So I guess one of the questions is, how does this impact our portfolio positioning? And for us, key points are we're quite sanguine or constructive on the Aussie economy. In March, we had another contrarian forecast, which was that the unemployment rate would settle between 6 and 7%. It's currently at 6.9%. That's been much more positive than the consensus, which said that the unemployment rate would rise to 9 to 10%. And we feel that further RBA rate cuts and QE will intensify the search for yield dynamics and put more downward pressure on deposits. We've actually recently taken profits on our bank senior bonds, selling $2.24 billion worth of paper. And we've switched into, right now, actually about $3 billion of semi-government bonds. And we've also bought quite a large quantity of high-yielding Tier 2 bonds issued by the banks. The semi-government bonds are state government bonds rated AA to AAA, and the Tier 2 bonds are rated A to BBB. And we think the Tier 2 bonds will benefit from the search for yield dynamics as they continue to evolve. And we believe that the semi-government bonds look very cheap relative to swap on a historical basis, and they'll benefit from the RBA's bond purchasing program, which will put downward pressure on their credit spreads and basically provide a tailwind to their prices. On the right-hand side here, we actually have highlighted the interest rates that New South Wales government bonds, which is the pink line, pay above the government bond yield itself, the Commonwealth government bond yield. So roughly speaking, at a 10-year tenor, New South Wales government bonds are paying about 40 basis points or 0.4% above the 10-year government bond yield. What's interesting is they're actually paying more than what you get on Western Australian bonds, Victorian bonds, or Queensland bonds, which we think is quite odd and an anomaly that will likely normalise. So we are seeking to exploit that